In this video, we're going to run through three key numbers you need to understand when trading. These three things are trading quantity, margin requirements, and swap adjustments. We'll run through each of these in a bit of detail with an example. So make sure you watch to the end of the video so you don't miss out on any of that information. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading to YouTube regularly. If you haven't already, make sure you subscribe to our YouTube channel then so that you get to know whenever we add a new video. Well, let's get into these three numbers. We're going to look at an example of placing a trade on dollar-yen using Trading 212's web app. And so the examples we'll be running through are for a currency pair position, but these three numbers do apply in general no matter what instrument you're trading. So let's have a look now at placing this trade on dollar-yen, and we'll see each of these three numbers at play. So here we have a 4-hour chart of dollar-yen, and as you can see, it's been moving higher recently. So let's say that I decide that I want to go with the flow and buy into this currency pair, buying the dollar, selling the yen. So let's right click and select open detailed trade box. And we have a bid and offer, a buy and sell price. And I'm going to alter this quantity to 10,000. So if I put in 10,000, we can see that my required funds changed when I changed the deal size and that matches the margin requirement down at the bottom of the ticket. And we also have this swap figure minus 11 pence. In effect, that's what it costs me each day that I hold this position if I am long the currency pair. If I go short the currency pair, we see that that swap number changes. It increases because it actually costs more to be short the dollar rather than being long the dollar. We can see that the margin requirement remains the same whether we're buying or selling because that's related to our deal size, our quantity only. So let's go back to buy, and if we put in, let's say 20,000, we can see that my required funds has now doubled and my swap charge has doubled also. Rather than costing me 11 pence per day, it's now costing me 22 pence per day to be long dollar yen. So I've selected buy. Let's click confirm buy. I want to do 10,000, not 20,000. So let's click confirm buy. My deal is done. We get the order executed confirmation, and we can see in my open positions the dollar yen among my instruments long 10,000 at my dealing price 108.577. So we saw there placing that trade on dollar yen, each of the three numbers cropping up in different ways. Well, let's now get into explaining them more fully. Let's run through in a bit of detail each of them in turn. And let's start with quantity, what we sometimes also call deal size or transaction size. What did that 10,000 that we dealt in actually mean? So in our example, our trading quantity, as we just said, was 10,000. When we deal in a currency pair, the trading quantity is actually the amount of the first named currency. And the exposure is actually in the second named currency. So we bought 10,000 US dollars and we dealt at an exchange rate of 108.602. So we were buying 10,000 US dollars and selling 10,000 multiplied by this number in yen. So this was actually 1,086,020 Japanese yen. So let's consider if the price increased by 1 pip. Now with dollar yen, 1 pip is this second decimal place here. So an increase of 1 pip would take the rate to 108.612. So the dollar would have appreciated against the yen. $1 would now be worth more, and our 10,000 US dollars would now be worth 1,086,120 yen. So an increase of 100 yen more than before. So 10,000 as our trading quantity in dollar yen is equivalent to 100 yen per pip. And if you had a sterling denominated account, then this would be reflected in GBP on your account. So the GBP Japanese yen rate would actually come into it for that purpose. Now we also saw with that dollar yen trade that there was a certain margin requirement, but how did we actually arrive at that number? So let's work through an example for our dollar yen trade, run through the numbers to see how we actually arrive at that margin requirement. So the margin when I dealt, we saw the required funds was £26.34. Now in our trading quantity example we just looked at, we said that we're doing 10,000 US dollars at 108.602, meaning we were selling 1,086,020 yen. And it's from this yen amount that we're going to work out what our margin was. My account for dollar yen is margined at 0.33%. That's the pro rate. And this means that for that yen amount, 0.33% of that is 3,584 yen. Now with my account denominated in sterling, once again, it means that the sterling yen rate comes into it. At the time I was dealing, this was around about 136.06. So if we divide this amount by this amount, then we arrive at this £26.34. And finally, there is the swap adjustment. We saw that the swap value changed according to whether we were going long or short. It also changed if we altered our trading quantity. So let's explain this now. So here we are once again in the web app, and I'm looking at a chart of dollar yen. And what can be useful is to go over to the information here on the top right hand corner where it says instrument details, and we can see the additional info here at the bottom of the screen, and where we have our margin, which is 0.33% for the position. If we scroll down further on, we can also see the short position swap and long position swap values. The swap that is applied to a position is like a kind of cost of carry. Sometimes this can be called a rollover cost or a rollover charge. It has an antecedent in the TOM next, the tomorrow next calculations of the traditional FX market. It's applied each night that a position is held, and it is driven by interest rates. In the case of trading a currency pair, it's driven by interest rate differentials between the two currencies. So in the case of dollar yen that we were trading, we were buying US dollar and selling the Japanese yen. Now US rates are higher than Japanese rates, so it's more favorable to be long than it was to be short, which is why we saw that the swap cost was greater if we were short. With interest rates being the way they are, the US dollar interest rate isn't sufficiently long for this to be a positive adjustment if you were long. But it is possible for certain currency pairs, if the interest rate differential between the two is sufficiently large, that you can actually have a credit for being long the pair. So let's actually work through the numbers of our dollar yen position. So our swap calculation from the app, we saw that being long US dollar against Japanese yen, the swap value was minus 0.001507. This is actually yen per dollar. So we have 10,000 US dollars. That was our trading quantity. We multiply this by that number, and that gives us the swap cost per night of 15.07 yen. We now need to convert that into sterling because our account is sterling denominated, and the GBP JPY exchange rate was roughly 136.06. So divide this by this number, and we get that overnight swap cost of 11 pence per night. So hopefully now you have more of an understanding of how the swap value is calculated. What's very convenient with Trading 212's app, of course, is that it calculates the swap value for you dynamically so that you can see at a glance what it is at any time. Let's finish off by looking back at my dollar yen position in the app now after a few days have gone by, and look at the swap adjustment there. My position is still open here. We can see, let's first just double check the swap time for this instrument. So I'll click on the info icon again and just scroll all the way down to the bottom, and we can see the swap time there is 2200 for this instrument. Now if we go to click on CFD at the top here and then reports and orders, and we can see that I opened my position before 2200 on the 5th of July 2019, which was a Friday. Now, as I'm recording this, it is a Monday. The market was obviously closed on Saturday and Sunday. So I've had my position open across that 2200 swap time on Friday, Saturday and Sunday. So 3 days. And if we go to the interest tab here, then we can see from my dollar yen position that I have got the interest charge there, the swap adjustment, minus 0.33. That's that 11 pence multiplied by the 3 days added to my account. So that was looking at the swap adjustment using Trading 212's web app. Don't forget you can download for free native mobile apps for both iOS and Android, and you'll find links to those in the video description. I hope you enjoyed this look at 3 key numbers you need to understand when trading. If you did, please take a moment to hit the thumbs up button and give us a like, or why not share your thoughts with us in the comment section. We do read each one. Well, that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.